Hello, everyone. Thank you for joining our financial literacy webinar today with our dear guest, Pouria Keshavarzi. He is an expert in this field, as well as someone who is dedicated to supporting community with education, knowledge, and financial skill literacy development. As many of you know, Foundation for a Path Forward, which is hosting this webinar, is the official faith community convener for the province of British Columbia, as well as the Strong Cities Network strategic partner for Canada. We work in public safety, education, jobs, community wellness, and well-being, and are working to make sure that all Canadians and newcomers to Canada have access to the best quality of life in terms of safety, development, well-being, and community harmony. Part of that initiative is helping folks understand and grow in terms of their financial independence and literacy. And we're extremely honored to have one of our experts in the field, Pouria, here with us today to introduce himself, a little bit about his work, and then the great presentation he has for us today. Thank you so much, Pouria, for joining.
Thank you very much, Yosef. Hello, everyone. My name is Pouria. I am basically investment and financial advisor in British Columbia. I worked in the finances about more than 8 years now, and I'm happy to share my information about the finance with you all. Especially this information is very needed for newcomers to Canada. And as you know, the more you know, the more you basically grow, and the more basically you flourish in this community and in this country. And the finance is one of the important things that basically every day we have encounter with it. And if we know how to manage our money, how to invest our money, how to prepare for to be retired in this beautiful country is very important. Today I have a presentation to discuss about the investments and growth of the investments and how we can grow our money in Canada. This is especially great for newcomers to Canada to start their investment journey in the right place and in the right step, basically. So just a disclaimer of liability. So I'm not accountant, I'm not lawyer, I'm insurance agent and financial advisor, but all these information that you get, always double check it with your advisor, with your accountant and lawyer, and this is only for educational purposes. Definitely, in future, if you want, we can have a meeting one-to-one, and I can explain all these information in more detail based on your situation. So we have something I call it wealth formula in Canada. So it's very important to show people how to save, how to grow their money, because saving alone is not enough, because you need to basically grow it. And the obvious reason is the inflation that we have in this country. So we need to know how to grow our money, and also we need to know how to make it tax efficient. So I save, I grow my money, I put it in somewhere that is have a good growth on my money, but also I don't want to pay the excess taxes. I mean, I want to pay my fair taxes, but not too much. We show the people how we can make our investment also tax efficient. And at the end, okay, I save, I grow, I make my money tax efficient. Do I want to lose it? No, for sure. We want to protect that investment. Also, not only our investment and our wealth, but also our health. So this formula is very complete formula and financial plan for someone that want to basically live a good financial life. So what is a net worth? The first thing that is important in finance is a net worth. When you go to the bank, always the one number that banks are looking at you is your net worth. And the net worth is assets minus liabilities. So when I work with my clients, I always want to increase this net worth. So either I increase their assets or I decrease their liabilities. This is the way that we do things here. Sometimes is okay to basically borrow funds to invest if the cost of borrowing, or COB, is less than ROI, or return on investment. So one of the big examples that we see all around us is investing in home. So let's say you get the mortgage of 2, 3, 4%, and you buy a house either as an investment or the one that you're living into. And as you know, especially the big cities in Toronto, Vancouver, Montreal, as you know, always the rate of appreciation of the properties is much higher than rate of the loan that you are getting. So last 20 years on average, in Vancouver, as far as I know, the rate of return on properties always was around 9, 10, 11%. So, and on the other hand, the mortgage rates was 3, 2, sometimes it came to 1% in 4 or 5 years ago, if you remember. So you always basically increasing your asset while your liability is not basically going hand in hand. So your liability growth is less than what your assets are. So you're always making net worth and you get more wealthier basically. Another big concept in the finance is a definition of interest. So interest is basically means the price of the money. So everything in this world has a price. I would say the interest in definition is the price of money. And we have two kind of interest. We call it simple and compound. So let's say you have $100,000 and you invested in somewhere that pays you 10% a year. If you invest that money in a product that pays you simple interest, every year you will get 10% of your money from your principal. So the first year you make 110,000, the next year 120,000, up to let's say year 21, which you make 310,000. But if you go and invest the same amount of money in somewhere that we call it compound interest, in that case, your amount of your money not only the interest not only apply to your principal but also apply to your interest. So in year one, here you see 110,000 will become in year 221,000, and up to year 21, as you see here, it goes to 800,000. So as you see here, your money in the where you invest in compounding product actually is near to 3 times at what you can get in a way that you invested in a simple interest. So where you get a simple interest, usually GIC in the banks pays you simple interest, but the same banks charge you compound interest in their mortgages and is in their credit card. So we always tell people this is not a really fair equation. So when I work with my clients, I want to make this vice versa. So you will get compound interest and you pay simple interest to your banks. Another big rule that we have in finance, we call the rule of 72. And the rule of 72 is simply means that if you divide number 72 by rate of return on your investment, the answer will be the time for your investment to become double. So let's say you invest $10,000, okay? If you invested in saving account, which usually pays around 1%, how long it takes your $10,000 to become $20,000? As you see in this table, with the 1% interest, your money takes 72 years to become 20,000. It's huge, yeah? So let's now assume if you invest somewhere that pays you 10% a year. In that case, your money, the time it takes for your money to become double is basically 7 years. So it's huge difference. So the more interest you will get on your investment, the less time it takes for your money to become double. So as you see in this previous slide, in the year 7, when we have a compound interest, our 100,000 become 200,000. In year 14 becomes 400,000, and in a year 21 becomes 800,000. So this is the power of compounding. One of the important things to know for all of you is a concept of early investing. So there is a many advantage when you start investing in your early years. I have a scenario here I want to show you is for three people. One is starting at age 20, one is starting at age 30, and one is starting at age 40. All of these three people invested 10,000 in the beginning as an initial deposit amount, and they put $100 a monthly, and we consider 9% annual rate of return on these three people. As you see here, the first person which started at age 20, and we consider all these three people will be retired at age 65. So the first person basically has 45 years to retire. The second person has a 35 years to retire. And the third person has 25 years to retire. The first person, which started at age 20, at age 65, he has $1,139,000 in his investment account, let's say in his RRSP. The second person basically invested the same amount, but 10 years later, now he has 473,000. And the third person started at age 40, which had a 25 years for growing their money, now has 191,000. So the difference between the scenario one and scenario three is that the person in scenario one can retire, while the third person basically cannot. And this is how important is to take advantage of the time and the compound interest. So the sooner you start, the better. So how you can grow your money in Canada? Basically, apart from growing your money in hard asset like real estate or in buying commodities, for example, gold, silver, those things. If you want to know where you can grow your money in capital market in Canada, there is three ways. You can either buy equity or stocks, or investing in the bonds, or investing in money market. So what are the definition of these three? So equity or stock means when you buy a portion of business. Let's say you know that Apple is a very good company, more than 2 trillion, 2 billion, $2,000 billion cap market cap. So let's say you have $100,000 and you want to invest in this stock, this Apple stock. So by investing 100,000, you become a shareholder and you own a very small part of this company. So now, if the company Apple stocks goes 15% up, how much your money goes up? I bet you know your money goes up 15%. If the company stock goes 10% down, how much your money goes down? 10%. Perfect. So investing in a stock is a factor of risk, but it gives your money potential return. Now someone can come to me and say, "Oh, Pouria, I love the Apple. Apple is a very good company, but I don't want my money to go up and down. I just want to have some kind of basically safety net on my principal." I would say, well, there is another option for you, and you can, instead of buying the business through their stocks, just lend your money to Apple. That we call it bond. So once you lend your money to Apple, Apple will issue something, that a certificate that we call it bond. And in that bond, we have something we call it coupon rate. And that coupon rate is between you and the company. Some years could be 5%, some years could be 4%, is fluctuating. But let's say you get a 5%. So in this case, when you hold the bonds of company Apple, if this company value goes up by 15%, is your money goes up, your principal 100,000? No. But what you will get the fixed income, which is the coupon payment, which is 5%. So for this 100,000, basically you will get 5,000 in return. And if the company value goes down by 15%, do you care? No, because you will get the same 5% income. So that's why in another term we call the bond fixed income. And in this case, investing in bonds is provide safety for you, for your principal, and also create the fixed income for you. So now let me ask you a good question. Let's say you have 100,000 in your pocket and you want to invest in the market. And when you go to the marketplace, there is a three player come to you and offer you. And they one of them is company Apple, and it says to you, Mr. Client, give me your 100,000 and I will pay you 3%. At the same time, TD Bank comes to you and say, I will pay the 3% as well. Give it to me, lend it to me. And the government of Canada also says, I will pay you 3% as well. Give it to me. So, which one you will give them? Is a good question, huh? Think about it. But if now Apple tell, I will pay you 13%, and the TD says 3%, and government of Canada says 3%. Well, in the first scenario, which all of them gives 3%, I bet you choose government of Canada. Because why? Because it's less riskier, you know? But in the second scenario, which Apple now pays you 13%, you at least think about it, right? I hope so. So why I give you this example? Because I want to tell you that humans always, if they want to take more risk, they expect more return. And all of you people agree that governments always has a lowest risk compared to any company, to any bank, especially government of Canada, which is a very safe government in the world. So definitely they are the less riskier. And since they are very less risky, do you expect that pays you high interest? No, they pay the lowest risk. Some of you might ask me why the government of Canada is safest. Because of two reasons. When you give your money to the government of Canada, never ever if something happens that they cannot pay you back, because they can simply go and print money through central bank and give you that money back. Do any companies can do that? No. So basically the default here is zero. And also governments generally and government of Canada can create income for themselves through taxes. So they can impose and devise new taxes and create more income for themselves. But do we have any companies in the world that can impose taxes to the people? No. Because of these two factors, governments usually in general are more safe. By giving you this example, I want to discuss the third instrument that we have in the marketplace, which we call it money market. So the money market is a government bond with the terms usually less than 1 year, mostly about 90 days, which they pays a very low return, 0.1% to 0.5% to the people. And sometimes we call it treasury bills or T-bills. They are very safe. They are especially is good fitted for people that want to invest their money in a, or we can call it park their money for a short-term period to go to a new project. Let's say if a company has a $10 million, $100 million, and they want to save it somewhere for a few months or a few weeks, they never put their money into the bank because of the risk issues. They go into the market and buy the treasury bills for that case. The next concept that I want to tell you is about the concept of investing versus trading. So what do I mean by that? Well, when you go to the market and you start buying stocks and bonds yourself, I call this trading because this is a full-time job. You basically sit behind your computer and buying and selling. And this is quite risky. You know, many people loses their money due to the trading because they don't know what to buy, when to buy, which one is better. Here, what we are telling you is that instead of go and trading, go and start investing. So what do I mean by that? I am saying that in order to invest, you have to consider two rules in any investment. The first rule is Don't completely lose your money. Okay? So any investment that you do, you shouldn't lose your money. While if you invest in a stock, you might lose your money because you can buy something and you lose it completely. The second one is that the investment that you do should provide you with growth of your money over time. So what is the example of good investment? What do you think? Yeah, you're right. One of the good example is a house. You can basically invest in the house because if you invest in the house, if even if the house go burned down, uh, you still have your money, your basically your capital is still is there because you can sell the land. So there is nothing happens. You might lose some money, but not all of it. So the rule number one is apply here. The second rule is basically, are you agree with me? If you invest in property anywhere in the world, after 10 years, 20 years, your money grows. I mean, your property grows in value. So this is the rule number two. So since the house has these two rules, basically, we're saying that investing in property is a good option. Another definition that we need to tell you here in the finance is about the risk. So what do you define the risk? Many people define the risk as basically losing money. I'm not saying this is not correct. It is. But if I want to tell you basically the real definition of the risk is fluctuation. So the more fluctuation you have in the investment, the more riskier is your investment. What is the one of the examples that you think is? Let's say Bitcoin, yeah? Bitcoin, basically, if you remember, in 2013 was a $1. And in 2017 goes to 20,000. Nowadays is over 100,000. But in the same time, in 2018, lost its value about 70%. So if you go and check out the price of the Bitcoin, you see that is going up and down very huge. It's like a roller coaster. That's why we say that the Bitcoin is a risky asset because its price is fluctuating very much. So the more the price of the investment fluctuate, the more riskier it is. So the high fluctuation means high risk. The low fluctuation means low risk. So if you see this picture is basically we call it a index chart, which is monitor the markets from different countries, from Canada and the US, from 1934 up to 2024. So about 80, about 90 years, basically, as you see here. And as you see, the graphic, the blue one up there, has the highest fluctuation. And if you have invested $1,000 in 1934, in 2014, that $1,000 became over $19 million. It's huge. Why? Because first, in the market, you will get a compound rate. And also, since this is a high risk, it means high return. So, and this blue one is basically the index of the small cap stocks. This is the index of small cap stocks in the US. So 1,000 become 19 million in 90 years. But if you invested the same 1,000, let's say on these treasury bills, which is the purple one in the down, 1,000 after 90 years, it become only $40,000, as you see in the graph. So this, you see, why is like that? Because the treasury bills are very, very low risk. It's not giving you that much return, but also your money never goes down, never goes minus or getting negative. But at the end, your money is not growing that much. So which one is better, the purple one or the green one? I would say all of them is good. Is based on your objective and how much time you have for investment. So if someone comes to me and say, Puri, I want to invest, let's say 100,000, but I need for the next 6 months because I want to pay for my down payment. I never tell them to go up and buy the small cap stocks. I know it gives them more money, but in the same time, maybe in 6 months, their money can go to 30% down or 40% down. So what's the point on that, you know? In this case, I will tell them either to park their money in the saving account or go buy a GIC because you want to take it out in 6 months. But if someone comes to me and say, Pouria, I want to become retired in next 20 years, then definitely I will tell them go buy, if you can tolerate risk, buy more riskier stocks. Buy invest in the stocks that can give you more return. And in that case, maybe the green ones is much better suit them. So it's not about the good or bad, it's about the client objectives and time horizon and also their tolerance for taking risk. As you see here, also we have the same concept of risk and reward on assets in the other markets, like in properties as well. So as you see in this graph, the dark blue one up there is an index for the price appreciation in Vancouver real estate. So for example, in March 2001, if you wanted to buy a house in Vancouver, you could buy it for $350,000, and in the next 10 years, in 2011, same house will become around 900,000. So, but in the same time, if you went to the Montreal in Quebec and invest $150,000 to buy a house, in 10 years, that house could be maximum 225,000. So as you see in the Vancouver market, you basically triple your money compared to when you go to Montreal and buy a house in Montreal. Why? Because we say the same exact fundamentals also here exist in the real estate. The real estate market in Vancouver is much riskier than Montreal. So the prices of the houses goes much up and down compared to Montreal. That's why, since you have more risk, but also you have more potential return here. And as you see here, the prices in the house or appreciation prices in the house are much higher in Vancouver compared to Toronto or even other cities like Ottawa, Edmonton, or Montreal. So the more risk, it means the more potential for return. The next item that we want to talk about is a diversification in investment. So what do I mean by diversification? Diversification means that don't put all your eggs in one basket, okay? So I have a question from you. Can Apple, which is one of the greatest companies we have now, can go bankrupt? Most of you might say, yeah, and you are right. Why? Because in 2009, the Nortel, which was one of the biggest Canadian company, went bankrupt. But can IT industry go bankrupt? I mean, we have over 6,000 companies in the IT industry now. Can all of them become bankrupt at the one night? No, for sure not. So the industry cannot go bankrupt. Or can I say that TD Bank go bankrupt? Yeah, TD is a very great bank, but could, yeah, maybe in future something happens, can go bankrupt. But because if you remember in 2008, Lehman Brothers in the United States went bankrupt. And if you remember, the financial crisis happened that year in all over the world, you know. So, but can banking industry go bankrupt? No. That's with that definition of diversification, I want to tell you now about the investment funds, which one of them is we call it mutual funds. And the mutual funds are the basket of 30 and more companies that their stocks and bonds are picked up by professionals, which we call that professional portfolio manager, and is created by investment companies, by insurance companies, and by banks. So, how the mutual funds work? Basically, people put out their small monies. They pull it out. They give it to these funds, and those funds now pull those monies and go in the market and buy the all kind of stocks, bonds, and money market. So, what is the benefits of mutual funds? First, the first basically benefit you get from mutual funds is that they basically very liquid. So if you invest, let's say 100,000, 10,000, whatever, if you want to basically take your money out, you can do it in 1 day. Or basically we call it 3 days settlement date. So it's very liquid. The next one is a diversification. And also the investment minimum that you need to put is very low. You can start investing with $25. And also is professionally managed. Okay, as you see here, there is a mutual fund we have here. And I want to show you those two rules of investment still apply here. So if you invest 100,000 in this mutual fund, your money never goes to zero. And always you gain over time. I mean, your money growing because of productivity and inflation. And as you see here, mutual funds can diversify. So they diversify under asset mix, sector mix, and regional mix. So they can invest in all different geographia, US, Canada, Asia, and also they can invest in other industries like IT, finance, auto, healthcare, and also they can diversify by asset mix. So they can invest in stocks, bonds, and money market. We have four different kind of mutual funds in the market. One, we call it equity funds. So in the equity funds, basically, this fund only invests in the equities of company. And since they only invest in equities of the company, they are very high risk, but they give you high potential return. Another one is a balanced fund. So balanced fund is basically is a 50-50. Equity, 50% equity of the companies and 50% bond of the companies. Their risk is medium. And they have a medium fluctuation, but as you know, it gives you medial potential for return. The third one is a bond fund. So bond fund basically invests 100% in the bond companies. So bond of the companies. So they are low, they have low fluctuation, low risk, and low potential return. And the last one is we call it money market fund. And in the money market fund, basically they invest only in treasury bills, government bonds, and those things. So they are very low fluctuation. They have a very low risk and very low potential return. Now I want to tell you about the segregated funds. Segregated funds are same as mutual funds, but they have a wrap of insurance around them. So if you go to the market to invest, you have three choices. Either you go to invest in GICs in the banks, which the advantage of it is principal guarantee, and disadvantage of it is low returns. The second one is a mutual fund. So in the mutual funds, if you invest, the advantage is that you have a potential high return in your money, But the disadvantage of that is there is no principal guarantee. Your money can come down, it's fluctuating. In the segregated fund, basically what we do here is we mix these two products together, GIC and mutual funds, and making it the more superior product here. Okay. So in the segregated funds, your principal is basically guaranteed if God forbid the clients dies. So let's say clients invested 100,000. If God forbid something happens to the client, uh, that money they invest in day one, even if goes to the half, let's say they invest 100,000 now, their money is 50,000 when they die, the family will get the 100,000. So this is what we call it principal guarantee. Also, you have a potential for higher returns, sometimes more than mutual funds. And also is a very great tool for estate planning. And also the money you invest in segregated funds has a potential creditor protection. So if something happens to you, if you go declare bankruptcy or consumer proposal, usually the creditors cannot touch your segregated funds. And this is very important because they can go after your mutual funds, they can go after your GICs, but not segregated funds. So as an advisor, I always tell people, if you want to invest in mutual funds, always at least invest 30%, 40% of your money in segregated funds as well. And segregated funds are offered by insurance companies only, not the banks. You cannot find them in the banks. And is one of the products that we sell in our company to the people. And we have contracted with more than 40 insurance companies in Canada. So we have a very, very good suits of all segregated funds from different companies that we can offer to our clients. Okay, so let me go. Yeah. So a segregated fund is an investment fund that combines the growth potential of a mutual funds with the security of insurance contract. And as you see, usually the segregated funds is much less risky because and also is very less costly when the times come and clients dies because, for example, they are not subject to executor fee, no probate fee, no legal fee, no potential state cost. And the distribution at date is approximately 30 days to 60 days to family compared to mutual funds that can go to few years even in a probate. Also, there are very private. There is a privacy law goes to the segregated funds. So when the state of the deceased person usually released, it goes through probate and goes become a public record. But investments in segregated funds are not subject to public record. So it's very good for, especially for the people that want to have some kind of privacy in their inheritance. Uh, this vehicle segregated funds can completely fulfill that. Potential creditor protection, it has segregated funds while the mutual fund don't have it. And also death benefit guarantee, which the segregated funds have and mutual fund don't have it. So the reset option, as I told you, is basically guaranteed of the principal in case of death, which if something happens to the client and they die and the market in the day they die is basically down and they lose money on their investment, the insurance company pays the difference and give the principal amount to the family. And if the amount of money that they invested is higher than what they invested, then that's fine. They give the highest one, higher amount to the family, basically. So I'm not saying that which product is better or best. For sure is not. It depends on the client. But if we want to just compare saving account, GICs, stocks, mutual funds, and segregated fund in terms of principal guarantee, diversification options, and potential higher returns, as you see, segregated funds basically fulfill all of those. So, what is the wealth creation steps? Well, I would tell all of you to start taking action toward your financial freedom. So, start your financial plan as soon as possible. Discipline yourself to protect and save before you spend. The ideal budget usually is between 10 to 20% of your gross annual income or monthly income, whatever. For example, let's say if you make 5,000 a month, I would say if you can at least go with 1,000 or uh, go with minimum 500 to 1,000 at least per month and save that money and invest that money before starting spending that. Also, managing debt and taking calculated risk is very important. If client has a high ratio of debt, I always tell them don't invest. Start paying off your debt because usually debts in Canada, especially if it's credit card and some loans could be over 20% in yearly interest, and very few investment can basically beat that rate. So it's better to always go and basically reduce your debt with your cash flow before investing. And we do basically financial planning for our clients, and we show them how they can reduce their debt in a cost-effective manner and in a very short period of time. Always have a 6 months of monthly income or even expenses of your family saved for emergencies. That money can go through the liquid vehicle, like could be a saving account. Also, if you have a good line of credit, which can cover you on a 6 month basis, with a good rate, low rate, I would consider that a good emergency fund. Because as you know, when we lose our job in Canada, it takes between 3 to 6 months to find a new job. And basically, having this emergency fund is helping us not to face any problem. And you need to be patient and also give a time for your wealth to grow. I mean, investing is very boring job, you know. It's very boring job, but is very fulfilling if you have a patient for it. So what we do for our clients, usually we do something we call it expert financial analysis. So in this report that I prepare for my clients, I go and show them different aspects of their financial life. So we work on their protection, debt elimination, investment and saving strategies, and also goals and dreams. And we provide them with at least 20, 30 pages of the good financial plan that they can use it either through us or through their advisors to plan a good financial plan for themselves. Your decisions to act on a financial education is the road towards a wealth creation for your family. So, with a tailored plan followed by discipline, you can secure your family's financial future. Any plan that you have is very important to have a discipline for it. Okay, so if you say I'm going to save this amount of my income every month, do it. If you say that I'm going to protect with my family with this kind of a strategy, do it. Don't postpone it to the next day. This is very, very important. And one of our job as advisors is to be basically our client's accountability partner. So we are. This is the one of the ways that is good to working with the advisor is that basically the good advisor can be a good accountability partner for you. And you remember, you cannot harvest something that you never sowed, you know? The next thing that I want to tell you is about the hard asset versus liquid asset in investment. So hard assets means like real estate or something that is not liquid. So if you want to sell a real estate product, is usually might take few months to sell it. While when you invest in the markets, as I told you, you can sell it in 3 days basically. How you can invest in the mutual funds or segregated funds is very easy. You can invest either lump sum or through the monthly. We call it PAC or pre-authorized contribution. And the third one is a basically mix of both. So invest some part as a lump sum and the rest on a monthly basis. And when you're using PAC or pre-authorized contribution, and if when you implement that strategy, you're taking advantage of the power of dollar cost averaging. And in the power of dollar cost averaging means that you can buy more units in a less price, especially when the market's going down. So in this example, as you see, someone with a $600 they invested every month, and instead of buying 6 units of let's say this mutual fund in the first month, they buy 18 units in the 6 months. And they basically in the downturn market also they gain in their investment instead of losing. So this is something that always I tell you guys to start investing not only lump sum, but on a monthly basis. Even it's better to do it weekly basis. I tell my clients to start doing weekly if you can. And when you do it weekly, you take more advantage of dollar cost averaging, and especially in Fridays, as in my experience, the unit price of these stocks and bonds usually goes down on average most of the year. So you can buy cheaper units, so your money makes more return for you. So how you can withdraw funds from your mutual funds or segregated funds? Same. I mean, you can all take it out lump sum all at once, or you can basically withdraw it on a monthly basis or weekly basis as well, whatever you like. And it's very, very flexible plans, basically. So the value of advice, this is something that I took it out from the Fidelity Investment. Fidelity Investment is one of the biggest investment companies in the world. They manage over $4 trillion, money of the people in Canada and US. They are one of the very big investment companies out there. And this is based on their survey and their data that it shows that people like you guys, when you working with the advisor, usually if you work between 4 to 6 years, you make on average 1.8 times more than someone that don't work with the advisor. If you work between 7 to 14 years, usually you see more than 2 times. And the people that invested with their advisors, usually after 15 years more, make more than 2.3 times. So these are the good numbers based on the statistics that this company had, and is very true. And the one way that I would say why this happens, because the most important thing when you work with the advisor, with a good advisor, is the good advisor can emotionally handle you and basically helping you. I remember in 2020 when the markets went down, especially for the COVID, it takes some of the stocks and mutual funds that I already invested for my clients. In the March of 2020, basically goes down by 40%. And many of my clients called me and told me, Pouria, sell it, sell it. Is a very bad situation. And I just told them, no, why you sell it? It's the best time to buy. And some of those clients actually instead of selling, they start buying. And you cannot believe it. After 6 months, all those downturn not only recovered, but basically goes 50% up. So this is how the clever people invest in the market. So support you get from your advisor to stay on track in the times of volatility is very important. Also, working with the advisor to show you how to invest more tax efficient is very important. Encouraging you to have a good financial habits, and also guiding you on your major financial decisions can be very fundamental. And at the end, personalized investment strategy for the long term is something that usually you need to discuss it with your advisor. So yeah, I put up my link here. So if you are interested to talk to me one-on-one on your specific situation, you can book a free financial consultation meeting with me. You can basically take a screenshot shot of this QR code or the link below. I am I will be happy to meet you. There is no cost, no obligation to work with us in our company. So uh, there is no cost, and we offer products and solutions basically virtually from all the big investment banks and insurance companies in Canada. So I thank you for your attention. I appreciate your time and attention. Also, your questions and feedbacks are very welcome. Feel free to reach out for more information. I am looking forward to our continued collaboration. So I'm here. If anyone have questions, Yusuf, I would be happy to
Thank you.
answer.
Thank you so much, Pouria. We do have a couple of questions that came in from people who were watching the chat. I posted them in the chat for you to see. I think just because we have about 7 minutes left, if you wanted to rapid round answer them or see which one you're interested in answering, I think the first one's kind of interesting. And
Well,
then the last one, as a Muslim investor, what are some
mm.
Sharia compliant? So I think if you were to maybe just get a stab at them, I think that would be awesome.
Okay, sure. First one, it says, what are the best strategies for building long-term wealth in today's economic climate? Is there a financial collapse coming? Well, I'm telling you, we are not in the market to predict if it's going down or is up. It depends on your situation. If you are someone investing long-term, don't really pay attention on the collapse of the market. Just go start, create your plan with the help of your advisor and also follow that plan. It's very important, okay, based on your risk. The best strategies for the building long term would be investing in the stocks, equity stocks, not on the individual stocks, but in the funds, based definitely on your risk and stay invested for at least minimum 7 to 10 years. So if you stay 7 to 10 years in any investment, especially equity funds, you will win. I can show you there. Should I balance paying off debt while also saving an investment fee or just pay off all debt? It depends on your debt. If you have a high debt interest, like 20%, I would say start going paying off that. If you have some money to save, go start paying off that debt. Don't stuck on those minimum payments. We have some strategies. We call it a snowball strategy that I can show you how you can not only start investing and the same time paying off your debt. We call it snowball strategy. It's a very good one. What tax efficient investment option should I consider before year end? Definitely you start with your tax-free saving account, the best account in Canada. Whatever you put in, there is no tax on it. It grows tax-free and you can withdraw tax-free. After that, based on your income, usually would be RRSP. If you are the first home buyer, go start opening your FHSA or first home saving account. So these are all the accounts that gives you the basically tax efficient. And I will I create another session hopefully for investing in a tax efficient way in Canada, and I will coordinate with Yusuf about it, and we can make another meeting, and I go more details into the accounts in Canada and how you can make your investment very tax efficient.
Awesome. We'll do that. I just before answering some of the other questions, one of our participants, Omar, was asking, do you have the link to reach out to you or an email that we can post in the chat
Yeah, I showed in my
in the QR
basically
code? Maybe if you
the
could
yeah
just share that again for one more second while you're
yeah,
answering the other
just hold on a
questions, just
second.
so
Yeah, for
yeah,
sure.
people
Just
can screenshot
yeah,
that.
I just go
And Omar, we're gonna also be sharing the live recording of this to our pages and Facebook, so you should be able to have that as well.
yeah. If you can take a screenshot of this, I can also send a link to you, Yusuf. You can send
Okay,
it to the people
sure.
as well,
I'll do that.
so they can book a free financial consultation with me here. And let me check the next question here. So, can you explain the risk and benefits of diversifying into crypto or alternatives? Definitely, very good question. Very good question. Definitely go for the alternative assets and crypto. I do it myself for myself, but always consider crypto and alternative assets are very risky, as I told you during the session. So if you want to go to that, go with the 5% of your total investment, max 10%. But I will say start with the 5%. Let's say you have $100,000 and you want to invest in the market. If you want to go with alternative investment, especially with crypto, I would say don't go over 5 to 10,000. Between 5 to 10,000 would be a good number. They give you a very good returns, but on the other hand, you saw the markets, they can dip. And when they dip very huge and like 40%, 50%. It is huge. As a Muslim investor, what are the some Sharia compliant investment options that avoid interest? Well, as I know some companies, I think I worked with one of them that they offer Sharia investments, but generally, I would say if you invest in equity funds, they don't pay interest. So interest comes from bonds, okay? Interest comes from the bonds. So if you don't invest in the bond funds, if you don't invest in the bonds funds and if you invest in equity funds, usually you are good to go. There is no interest there because the equity funds pays you in two ways, either through the company dividends or through the price appreciation of the stocks, which both are halal. So that's my point of view. But we have some special companies that they offer funds, especially for Sharia funds. If you want, just book a meeting with me. I will show you. Would be okay. Okay, I think that's all, huh?
Beautiful.
Yeah,
Um, and right on time.
yeah.
So amazing. I think I really enjoyed this. I know like the comments I'm seeing from people who are texting really enjoyed it. We're gonna record this and we're gonna post it on our social medias. And then, Pouria, let's work on those next lectures. I think this is great. And
Definitely, definitely.
yeah,
I have two more basic sessions that I will coordinate with you. One would be around investing tax efficient in Canada, which is very
okay.
important, how to make our investment tax efficient. And I will go over all the accounts in Canada, what's the difference between them. And on third session, we discuss about the protection of your wealth and your family and your health. And that goes very deep into the different insurance plans which you need to know for your family in Canada, and we discuss one hour at least for that as well.
Beautiful. Well, thank you so much.
Yeah.
Really appreciate you sharing your wisdom and knowledge. I want to thank everyone who's joining on the call as well as online and people who are streaming. Thank you so much. And we'll share you all the contact information with Pouria. So if you're interested in his services and his support, you can take advantage of that, as well as we'll get you guys updated on the next session in this series. So thank you so much, everyone. Have a beautiful day.
Thank you very much.
Thank you, Pouria. I'm going to